One of the main challenges facing the crypto industry is the lack of clear and consistent regulation. In the US, the Securities and Exchange Commission, SEC, has been cracking down on crypto exchanges for allegedly violating securities laws. The SEC is led by Gary Gensler, a former Goldman Sachs banker and MIT professor who has a deep knowledge of crypto and blockchain technology. But he also has a tough stance on enforcing the existing rules and protecting investors from fraud and manipulation. In the past year, the SEC has launched several lawsuits against some of the biggest and most popular crypto exchanges in the world, such as Binance and Coinbase. These lawsuits accuse the exchanges of offering unregistered securities, operating as unregistered venues, commingling customer funds, inflating trading volume, and engaging in deceptive practices. The SEC claims that these actions harm investors and undermine the integrity of the crypto market. The SEC's lawsuits are based on the premise that most crypto tokens are securities, which means they are subject to federal laws and regulations. The SEC uses a test called the Howey test to determine whether a token is a security or not. According to this test, an investment contract exists when you invest money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. If a token meets these criteria, then it is a security and must comply with the SEC's rules. However, the crypto industry argues that the SEC's approach is outdated and unclear. They say that the SEC has not provided enough guidance on how to apply the Howey test to different types of tokens, which have varying degrees of decentralization, utility, and governance. They also say that the SEC is regulating by enforcement, rather than by rulemaking, which creates uncertainty and confusion for the industry and its users. The crypto industry has been calling for more clarity and dialogue from the SEC, but so far they have not received much response. Instead, they have faced more legal actions and threats from the regulator. The SEC's lawsuits have significant implications for the future of crypto in the US and globally. They could result in fines, penalties, injunctions, or even shutdowns for some of the exchanges. They could also affect the availability and accessibility of certain tokens for US investors. On the other hand, they could also lead to more compliance and transparency in the crypto market, which could enhance its legitimacy and stability. The outcome of these lawsuits is still uncertain, as they could take months or years to resolve in court. In the meantime, Gary Gensler and his SEC team are showing no signs of backing down from their assault on crypto markets. They are determined to enforce their authority and protect their jurisdiction over this emerging and disruptive sector. Gary Gensler is the chair of the Securities and Exchange Commission, SEC, the U.S. agency that regulates the stock market and other financial markets. He is also a former professor at MIT, where he taught courses on blockchain technology and digital currencies. He is widely regarded as an expert on crypto regulation, but also as a tough enforcer who does not shy away from cracking down on crypto platforms that violate U.S. securities laws. Gensler's stance on crypto reflects his view that the industry is built on non-compliance and lacks trust and transparency. He believes that most crypto tokens are securities, which means they should be registered with the SEC and follow strict rules on disclosure, investor protection, and market manipulation. He also thinks that crypto trading platforms and exchanges are essentially operating as unregulated securities markets, where investors are exposed to fraud, theft, and hacking. Gensler has repeatedly warned that crypto platforms must embrace regulation or face legal action from the SEC. He has said that regulation is necessary for crypto to survive and thrive, and that without it, crypto platforms risk losing trust and becoming irrelevant. He has also said that he will work with Congress to create new legislation that would increase crypto oversight, especially for stablecoins, which are cryptocurrencies pegged to the value of a stable asset like the dollar. Some of Gensler's actions as SEC chair have sparked controversy and criticism from the crypto community and some lawmakers. For example, he has sued Coinbase, the largest U.S. crypto exchange, for allegedly violating securities laws with its lending product. He has also declined to approve any Bitcoin exchange-traded funds, ETFs, which are seen as a way to bring more mainstream investors into crypto. He has also resisted calls for more clarity and guidance on how the SEC determines which crypto tokens are securities and which are not. Gensler's approach to crypto regulation has significant implications for investors, entrepreneurs, and innovators in the crypto space. On one hand, some argue that regulation could bring more legitimacy, stability, and growth to the industry, as well as protect investors from scams and losses. On the other hand, some fear that regulation could stifle innovation, drive crypto companies overseas, and limit consumer choice and access to new financial opportunities. Gensler's crusade against crypto could have implications for the future of innovation, regulation, and competition in the sector. Here are some of the possible scenarios that could unfold. If Gensler succeeds in imposing strict rules on crypto platforms and products, he could stifle innovation and drive away investors and entrepreneurs from the US. This could create a regulatory vacuum that would be filled by other countries that are more friendly to crypto, such as Singapore, Switzerland, or El Salvador. The US could lose its edge in the global financial system and miss out on the opportunities that crypto offers for economic growth, financial inclusion, and social impact. If Gensler fails to rein in crypto, he could face backlash from lawmakers, regulators, and consumers who are concerned about the risks and harms that crypto poses to the public interest. Crypto could become a haven for fraud, money laundering, tax evasion, and cyber attacks. It could also undermine the stability and integrity of the traditional financial system and threaten the role of the US dollar as the world's reserve currency. Gensler could be accused of being negligent or complicit in allowing crypto to run wild and endanger the national security and welfare of the US. If Gensler strikes a balance between regulation and innovation, he could foster a healthy and sustainable development of crypto in the US. He could create a clear and consistent framework that would protect investors, consumers, and markets from abuse and manipulation, while also encouraging innovation and competition in the sector. He could leverage the potential of crypto to enhance the efficiency, transparency, and inclusiveness of the financial system and support the social and environmental goals of the US. He could also cooperate with other countries and international organizations to harmonize global standards and norms for crypto and promote a fair and orderly global market. As you can see, Gensler's crusade against crypto is not just a personal vendetta or a bureaucratic power play. It is a pivotal moment in the history of finance and technology that could shape the future of money, markets, and society. How Gensler navigates this complex and contentious terrain will have profound implications for everyone involved in or affected by crypto. That's why we need to pay close attention to his actions and words, and hold him accountable for his decisions and outcomes.